Hey everyone, Hunter Satterfield here, one of the partners of CWA as well as a Chief Investment Officer. As always, I am joined by my fellow partner over here on my right, Brian Bortz, the head of our investment committee, and then Brad Sanders over here on my left, the Managing Director of Tectonic Advisors. This is your September market update. For the month of September, the S&P 500 was up 3.6%, global stocks up 3.4%, domestic bonds up 1.1%, and then global bonds up 0.7%. So obviously a great month across the board, which we've talked about throughout the year as we dealt with Fed cuts heading into the end of this year. So as we're in person today, this will be a great conversation. We are going to talk about the government shutdown here in just a second. Brian's going to talk through that. But Brad, I want to come over to you first. Talk a little bit about Fed did a 25 basis point cut. That was sort of predicted by many of our managers in the fixed income space. You've been working with them behind the scenes too, just to understand what's coming as we head into the end of the year. So you want to talk a little bit about what the Fed cut impact was on the market, as well as kind of what we're seeing going forward?
Sure. I mean, the impact, 25 basis points doesn't move the needle too much. It's more symbolic that they've turned, I would say, moderately dovish on the margin. So that's a good thing. And they did mention that they expect more cuts in 26 and 27 and have a Fed funds target rate of 3.1 by 2027. So that's materially lower from here. I have met with some of our managers since then, some of the PMs. And one of the ones that's actually, has a pretty high batting average on guessing Fed policy has told us, this was just last week, that they're expecting 2 more cuts just this year. So that would be at this month's meeting and then December's meeting. There's only 2 meetings left. And then 3 more next year. So that's going to get, if they're right, that'll get the Fed funds rate to 3.1 by late 26, which is a little more accelerated than the Fed was willing to say. So I think that's a good thing. I think once you start getting the Fed walking down rates, and that becomes a little bit more predictable as long as the economy's playing ball. You're going to start to get the 30-year mortgage with a 5 handle. That kind of turns activity back in that space on, and it just does a lot of things economically. Obviously, resets debt lower, credit card rates lower, helps the consumer, all that good stuff too. So I think we are going to be in a little bit of this stagflationary environment, but as long as it stays moderated and inflation stays sticky around 3%, which is what kind of our baseline is. You'll have core PCE around 2.8, so the Fed can't get crazy here. They can't cut by more than a quarter point at a time, more than likely. But as long as we kind of stay range bound there and they're able to walk those rates down, that'll be really good going forward. And I think the market's pricing in another cut this year. If we get 2, that could be a little bit of a Christmas surprise and have a really nice end of the year.
Yeah, and I think there's obviously a lot that's out there, which to a certain extent is surprising maybe at first glance that the market's up, because we've talked at length about volatility both on this recording and also when you've been on the podcast. And we certainly continue to expect that volatility. There are still lots of things that are out there, folks. We've got, are tariffs going to stay or not? What are the implications on tariffs into prices in the economy? What are the implications more broadly on what stays here versus what continues to be done offshore? And now, Brian, we seemingly also have another government shutdown, which these are not unique. I think probably a lot of our listeners are aware that this is something that we do go through time after time, and a lot of it becomes partisan. But you want to talk a little bit about how the market responds in times where we're dealing with a government shutdown?
Sure, yeah. Since 1981, this is actually the 11th government shutdown since then. The other 10, only 3 of them lasted longer than 5 days. So these are usually not very long-lived things. However, this one doesn't appear to have a very short end in sight, so you may need to buckle in. But the long story short is that the market usually is fairly agnostic to these things. When the government shuts down, the market really has not negatively reacted at all. In fact, most of the time, the market actually kind of rips up a little bit whenever there's a government shutdown and then that gets resolved. So the longest one was in 2018, I think, December of 2018, I think. It was 35 days. So that was the longest government shutdown. If anyone listening to this works for the government, has family that works for the government, you could have issues there with getting paychecks timely and things like that. But other than that, from a global economic perspective, it's kind of much ado about nothing from a market perspective. Now, the talking heads on the morning shows are going to tell you that there's going to be an impact, and there could be, but it should be negligible, and historically speaking, you just don't see it that much. So.
Yeah, and obviously this is changing a lot. We're here every month. We've got a lot into the end of the year, as Brad already mentioned. So we'll certainly be back in front of you after another Fed meeting, which will be interesting. In addition, both of these guys have joined us recently on the podcast multiple times to talk through a lot of this stuff as well. So please grab that as well if you want something that's maybe a little bit more on the weekly basis. Otherwise, we will see you at the end of October. Thank you so much.